Welcome to Leaders in Action Looking Ahead. I'm Robin Termingham of the Olderhood Group, and my guests today are Olderhood CEO Bill Story and Brian O'Hara, who is the former chairman and CEO of Excel Capital. Today we're talking about the outlook for the insurance industry. Brian, it's great to chat with you again. How's everything?
Great, Robin. Great to see you. Nice to be with you and Bill.
So obviously the pandemic has affected every kind of business there is. How has this affected the operation of insurance?
On the underwriting side, I don't think it's had too much of a negative impact. On the broker side, however, a big part of the broking environment is getting people together and building relationships.
Mm-hmm.
And in the placement of more difficult, technical, complicated risks, it really does require a lot of human interaction. And so the Zoom is very limiting for the brokers. And I'm sure that they can't wait to get back online in the action. The pandemic has actually accelerated the digitalization on the underwriting side, and has pushed technology advancements a lot faster. And when the pandemic's over, I think we're going to see a big difference going forward, especially with the new entrants to the market, who will be really adopting digitalization right from the beginning and won't have any kind of legacy issues, and will have a very streamlined and using cloud technology and artificial and augmented intelligence.
That's a very interesting point, because I know there were quite a lot of new insurance companies formed in Bermuda last year. How do you think that is going to affect their ability to attract new customers?
I don't think that attracting customers will be that much of a problem. I think with the approach of using technology first and foremost, from the start in their organizations, I think they're going to be able to demonstrate efficiencies and great underwriting analytics that I think will attract brokers and their customers.
I was talking to somebody the other day, and we talked about, when we're doing our sort of personal webinars, we have an expression called the unexpected fund. So that if you're budgeting for your personal income and expenses, we always say to people, you always should put a little bit away for the unexpected. Now, that being the case, then obviously the pandemic is what I think could be classified as an unexpected situation. I wonder if, as a result of this pandemic, that the underlying insureds, the companies themselves, the industries themselves, do you think they're going to pay more attention to being properly insured?
Well, I think I'm already hearing about it, especially among the Fortune 500, is using their captives to start building capital and reserves toward the next unknown, especially if it's anything around a pandemic-like situation. So I think you're going to see the captives taking a lot of new risk going forward that won't necessarily help the insurance industry, although they can use the captive for a base and then build excess tower on top of that. And in fact, a company I'm on the board, which is a insurtech startup of a couple of years, Envelop Risk. They are actively building technology to analyze and try to predict the triggers of loss for the next pandemic. And I think they'll be in position to work with the captives.
The underlying theme, shall we say, of the captive is a form of self-insurance. And I think over many, many years, we came across many people, executives, etc., who perhaps saw insurance as I don't want to say an unnecessary expense, but a bit of a nuisance type of an expense. Why do we have to spend so much money to buy insurance when we know, ha ha ha, that nothing will happen? So why are we carrying the expense of the insurance? Therefore, the idea of going self-insured, that if something does happen, then it's coming out of our pocket. Now, there may be limits and levels above that, obviously, in the case of sort of excess liabilities and so on and so forth. But do you think that that will bring people back to the center again and say, hey, look, let's be really clear about this. We do need insurance, and while we want to minimize the expense, if the self-insured path makes more sense for us financially, let's have a really good look at that.
The market is changing considerably, especially in casualty and directors and officers, and a few other lines, well, most lines of business, but particularly in those, and particularly in the excess area. I'm told that the rates are going up so much on the excess layers that the insureds are buying less limit because they only have so much at budget that they're willing to spend on the insurance. So, I mean, they definitely will take more and more risk in the predictable area, but the excess, it's hard for them to take a whole lot of risk without it exposing their budgets and bottom lines, which, that's forgotten. They got to make their earnings, and they don't need an insurance event to hit their earnings. So they will probably take more at the bottom, but they're still going to have to buy a lot of excess. But as they may start looking at trying to meet that unpredictable event and be more creative in that regard.
So, Brian, globally then, is the demand for insurance products increasing, or are we just seeing sort of a remix of the products that are selling?
No, the demand is very strong, even with rising rates that are going on pretty much around the world. Again, they need to buy insurance to give more predictability to their earnings stream. As we know, reinsurance is very lumpy. It's very volatile, and regular companies don't want volatility. They're willing to pay to take the volatility out, and so that is always going to be of huge value to most companies that buy insurance.
So do you see fresh capital coming into the insurance industry as a whole, whether that's the insurance level or the self-insured level or the reinsurance level? Is more money coming in? Is more capital coming in?
Well, it has been. There have been some real notable ones like Convex, who has brought in a large amount of new capital. But there are 4 or 5 other notable startups with significant capital, and as in talking with them, I know that their view on how they want to build a company is going to be much more virtual, much more technology driven, outsourced. There are areas like in the claims management area that the legacy way that the industry has done it is highly inefficient, and I think the runoff companies have shown that there are much better ways and cheaper ways, efficient ways of handling claims. And these new companies will be in a position to start their business and build their business around much greater efficiencies in many areas, which will enable them to take more risk on one hand, broader risk on another, but also be able to be very competitive on their pricing, and with the knowledge of what much better analytics on what the real risk is and what it should be, what the premium should be.
So is fresh capital available from the investment world, shall we say?
There's so much money in the world right now, it's scary, literally. I don't know how this is going to end up, but capital is that's why the stock market is just continues to go up on valuations which are reminiscent of 1999, 2000, just crazy. And yeah, I personally wouldn't touch a tech stock at this point on these valuations. Value stocks maybe, but there's nowhere else to put your money there. And this is true with the insurance industry. Back when I was active, a large part of my income was investment income. And that's not today, because back then we could buy high quality bonds yielding 7%, even 8.
Yeah.
Today you get 1. And that's not exactly going to pay the bills. And because of rating agency requirements, you can't have too much in the way of equities or private equity because of its illiquidity. So the industry is really hamstrung on getting return. On the other hand, there's so much capital looking for something to do, and particularly with the hardening market that we haven't seen in quite a while, which was exacerbated too by the pandemic. It was going to happen anyway, but the pandemic made it more dramatic. So, there's a lot of private equity in particular that is coming into the industry, and there'll probably be more.
You make some excellent points about the very unanticipated way that the pandemic and all of these global changes are impacting the market at large, as well as insurance. Brian, I want to thank you very much for taking time out of your schedule to chat with us today. You've been watching Leaders in Action Looking Ahead. If you have a comment or a question about the series, you can reach out to us at Bill, that's BILL, at olderhood.com. And we look forward to chatting with you again soon. Take care, everyone.